Sometimes, to know how well we are doing, we don't just use our current results. We can compare our current results with the old results. We can compare it with the results of people around us that did the same thing we did. We could even compare our results with what we think is expected of us. Like if the pass mark 1 exam is 70 and we scored 67, we can tell we didn't do as well as expected. Ratios can help in business to see the relationship between values. There are different types of ratios, and every type of ratio has its use. Profitability and efficiency ratio can be used to see how effective management is in making profit. Profit is divided by sales and multiplied by 100 to get percentage of sales that turned into profit. The net profit and the gross profit are divided by sales to get the net profit and gross profit ratios. Other profitability ratios are the return on capital employed and the asset turnover ratio. Liquidity ratio are used to measure how well the company can pay its liabilities when they are due. One example of liquidity ratio is the current ratio. To get your current ratio, you divide your current assets by your current liabilities. It shows if the current assets can pay for the current liabilities. Another liquidity ratio is the quick ratio. To get your quick ratio, you remove inventory from current assets before you divide by the current liabilities. For example, if a company has current assets of 30,000 and liabilities of 20,000, the current ratio 1:5:1, meaning the current assets can pay for the liabilities 1.5 times. If the inventory is 10,000, the ratio is 1:1, meaning the current assets can cover the current liabilities only once. To know how many times the company replaces its inventory, you can divide the cost of goods sold by the average inventory. This is called the stock turnover ratio. Investors need to know if their investments are growing. The ratios investors are interested in are investment ratios. The earnings per share show how much the shareholders earn per share. For example, if the company makes a profit of 500,000 after tax and pays 50,000 to preference shareholders, if the company has 45,000 ordinary shares, the earning per share is the profit after tax minus preference dividend divided by the number of the ordinary shares. In this case, the earning per share is 10 naira. Dividend per share is gotten by dividing the amount paid as dividend by the number of ordinary shares. Different users of financial information are interested in different ratios. Investors use the investment ratios. Managers and employees need profitability ratios, and creditors use liquidity ratios. See you in my next class, guys.